Ballpark figure we talking here?
Right. 250.
£250.
As stock markets tanked in March, Ruffer Investment Company enjoyed a gain of 4.2% thanks to a number of derivative hedges proving their worth. The investment team noted that derivative protections were critical in countering its equity losses during the month. In 2017, Ruffer were identified as a big buyer of volatility options designed to protect its funds from another market crash. The contracts, which cost $0.50 each, earned Ruffer the nickname 50 Cent, after the US rapper famous for the album Get Rich or Die Tryin. Despite initially losing money on the contracts, their strategy paid off recently, as they announced that they had made a total of $2.6 billion during the stock market sell-off. Ruffer, which manages roughly $23 billion in assets, invested $22 million in derivatives tracking the VIX volatility index. When the stock market tanked due to the virus, the VIX spiked to record levels and netted the fund more than $800 million. Ruffer gained another $1.3 billion by investing in credit derivatives that surged in value after corporate bond prices slumped. It also netted $350 million from S&P 500 and Euro stocks put options, and $145 million from gold hedges. Basically, a put option just allows somebody to lock in the sale price of an asset. If someone owns a put option, they can force someone else to purchase an asset at a set, predefined price. That agreed upon price is known as the strike price and is defined in the option contract. The actual market price of that asset might end up being significantly lower than the strike price, but the put option has locked in the sale price. This is essentially how Ruffer made bank on the S&P 500 and Euro stocks put options. A call option is just the opposite of a put option, and this is how Ruffer made bank on the VIX. Ruffer also performed well in the 2008 financial crisis thanks to their well-diversified risk portfolio. On their website, Ruffer describes how their two investment objectives are not to lose money in any rolling 12-month period and to grow funds at a higher rate than cash. The recent sell-off is a prime example of why diversification is so important, and also why it is vital to protect against large losses. Due to the mathematics of compounding, the big losses are essentially all that matter to your rate of compounding, not the small losses and not even the big or small gains. Of course, we have seen how Universal Investments, the hedge fund advised by Nassim Taleb, returned 3,612% in March, and 4,144% in the first quarter of 2020. In Ruffer's latest fund report, they gave their reasoning behind adding to their yen allocation. A number of factors argue for yen appreciation. Japan's oil imports are now much cheaper, its low interest rates are no longer such a rarity, and the Bank of Japan will find it hard to surpass the stimulus efforts of others, given how much of the Japanese government bond market the bank already owns, to name just three, and this appreciation would be turbocharged if further distress or defaults were seen in the US corporate credit market, as Japanese investors repatriate their significant investments there. Worldwide, it is the currency that looks most like gold and is therefore deserving of a significant allocation. Now to close, we have an interesting exchange in the comment section of the Citywire piece. Speaking of which, please throw a comment down there for the algorithm.
I'm gonna be brutally honest with you. You may not like some of the stuff that I say, but I promise you I'm not gonna lie to you.
JB1980 comments,
"One good month in 10 years.
Lance responds, absolute performers v relative. If capital protection is your thing, Ruffer are superb. No nightmare calls that 3% of your money has disappeared. JB claps back.
Absolute return implies above inflation return. They have made 8% in 5 years. I'll do the maths for you, Lance. That's 1.5% a year compounded. What do you think real inflation has been? 4%? They haven't even beaten cash. Hardly a victory. Any more questions?"
Lance replies, every individual can decide where they want to invest. In 2008 and now in 2020, Ruffer proved that if you want to avoid substantial losses, they have the tools in place. I'd also appreciate it if you desisted from making sarcastic comments. JB goes in for the kill.
"You are right. They avoided losses on both of those occasions, but they also avoided gains in the interim. Thanks, Lance. Enjoyed our chat. Have a great Easter and stay safe."
No response, no sign of life from Lance. Either he took the stoic approach, or... For more compounded valuable content, subscribe and like.